And we are now recording. This is Multifamily Masters Live. We do this once a month. We try to provide as much valuable, as much free content as possible. We are multifamilymasters.com. Who are multifamilymasters.com? Hold on here. Let me, I got to change a section here. We are multifamilymasters.com. We have 70 plus meetups across the globe, Hong Kong to the US to Canada. If you're interested in hosting a meetup, reach out to us. We not only help you form, strategize, implement your meetup, we will help you strategize and implement and take your multifamily business to the next level. We also have a Multifamily Masters Mastermind. What is that? That is a group where we hold each other accountable. We want to make sure that you know this business inside and out. We want to hold you accountable because we want to partner with you. This is a team sport. We're going to go a lot further together. If you need a solid team, a solid foundation, a solid group around you of like-minded individuals, reach out to us. I would love to send you information on our mastermind. If you're not a member of our Facebook group, multifamilymasters.com, you are missing out. 6,000 to 7,000 members in that group. Get on Facebook, hop on the search bar at the top, search for multifamilymasters.com and make sure that you join that group. And I'm still admitting people if you see me get a little sidetracked here. We have a YouTube channel where we will post this video when it is complete. We're also airing live on Facebook right now. If you are not registered for this Zoom, you are missing out. We will have breakout network session later on. We will have a large Q&A. Any question you have about anything multifamily, feel free to ask. Any question you have about anything that goes on with a deal, once you have it under contract, feel free to ask. Type your questions in the chat below. Comment on the Facebook live feed. We're here to answer it. If we do not know the answer to it, we will find it. I already mentioned the YouTube channel, multifamilymasters.com. We have a monthly newsletter. On top of that, we have fun events planned throughout the year. Long story short, we are multifamilymasters.com, and we're just here to provide as much valuable content as possible. My two business partners and myself, we own, manage, and control 3,000 plus apartments. We have 30 plus years of experience. Me personally, I've been doing real estate full time for 20 plus years. I've done nothing else since college. I'm not a very smart guy, but I do know a thing or two about real estate, and that's about all I know, plain and simple. My name is Garrison Gilbert. I'm in Baltimore, Maryland. My two business partners, Mr. Powell Chee, Mr. Feras Moussa. I will let them go ahead and introduce themselves. Hit it, fellas.
Sure. So I appreciate that, Garrison. Garrison always does an awesome job for us on our intros. There's a reason why we have him go first. So I am Powell Chee. I live in Los Angeles, self-storage and multifamily investor. All of my investments have been out of state, so outside of California. And let's see, started this group with just about 8 of us about 3 years ago. So a little over 3 years ago. It was actually kind of our 3-year anniversary, would have been in December. And since then, this group obviously has grown significantly. And like Garrison mentioned, we're worldwide now. And when it comes to my investing and what I've been doing, I've been involved in 7 different multifamily projects, 5 of them different syndications, all over the past, I would say, 4 years now. And most recently, we'll be talking about probably my self-storage deal. So like some of the topics today were just like some of the deals that we're doing right now. And so I most recently closed on a self-storage deal, but we'll get into some of that later. But how about you, Feras?
All right. Hello, everybody. Hopefully most of you know me, but for those that don't know me, I'd like to know you. So, for me, my background came from the tech world, found out about real estate almost accidentally. I had a software company for a little bit, was building property management software, but kind of got into the investing side and realized there's things that I like: people, numbers, and systems. And so, with that said, kind of doubled down, have a company called Disrupt Equity. And today, we have properties in Texas, and we're also vertically integrated. We have our own management company. We have kind of the acquisition side, and we have a couple of other key partnerships. And so I know a lot about business acquisitions and, the good, the bad, the ugly. So happy to kind of talk through all those. And so with that said, you guys are not all here to hear me, Garrison, talk about our backgrounds, right? today's topic, right? We figured we would kick off the new year, really focused on kind of not really mindset, like talk about how do you kind of do that first thing that a lot of people want to hear about, right? Which is doing a deal. And it just so worked out kind of time-wise that me, Garrison, had something going on at the same time. And so, we figured, hey, it'd be a good opportunity to really just do a little bit of a showcase and kind of talk about what we each have going on in terms of the deal, give the background about it, right? What attracted us to it? How did we find it? What's been going on in the process, and kind of what the next steps are on each. With that said, Garrison, Powell, which one of you guys want to go first?
Go ahead, Powell.
Okay, sure. So I guess I'm going to talk about the most recent deal that I did, which was a self-storage deal, and I just closed on it recently. So just to bring us back a little bit, during COVID. So how recently did I close it? 2 weeks ago. 2 weeks ago.
I should not know that answer better than you, pal. Come on, man. All right.
2 weeks ago. So during COVID, I mean, the way that my multifamily operations go, it just ends up being, since I'm all out of state, I don't have one particular market that I'm looking at, right? And when you have one particular market, or maybe a couple different markets, you're able to really dive into sort of understand your markets like an expert, right? I kind of use more of a broad approach, more of a shotgun approach, and that approach really doesn't fit well when COVID happened. So because you're not able to find the deals that are the great deals when like things are going down, and you need to be able to act really fast. Okay, so I need a little bit more time to do my evaluations of markets and the areas and everything. So when COVID happened last year, I did a shift and started saying, well, I know I'm not going to buy anything for at least 6 months. And so during this 6 month time, I said, because I'm not going to buy anything, I have a lot of time now to look into my secondary asset class, which has always been storage. I just never knew how to invest in storage. I didn't know how to evaluate it, didn't know what was a good deal, didn't know how to underwrite it or anything like that. And so that's what brought me to storage. And just like a lot of you and a lot of us, I did I got some coaching, listened to a lot of podcasts, YouTube, forums, websites, anything I could to just devour storage at that time, because I knew I wasn't looking at multifamily. So all that said, was able to find some deals, put some LOIs out there, and then put it under contract in October. So I'll leave it there, and then we can, just as an intro to the property.
Got it. So you just want to kind of do the intros, and then we'll continue on the story. All right, that works. All right.
Unless you want me to continue, but I figure, I don't want to hog the whole time talking.
I feel like probably continue on. It's going to look, because they're very different deals, so it might confuse people. So I would say go ahead and roll with it.
Okay.
So maybe the next question really that I would add is how did you analyze it, right? Because I know most people, that's the things that they want to understand, right? How did you go from multifamily? We've talked about it a lot. How did you learn about, you mentioned podcasts, reading books, but was that sufficient and you just kind of hopped in, or was there a specific resource or process that you kind of use to analyze?
Yeah, so I did go through some paid coaching, right? So I bought a course and bought an analyzer, realized like what the difference is between that analyzer and how I'm analyzing in multifamily. And if you're good at analyzing in multifamily, I mean, it's not something it's totally different from you. You understand the P&L, you understand what's, how to underwrite things. So you can pick it up. It's not very difficult, but there is different things that you should look for, right? So in storage, you're looking a lot more for square footage, where square footage isn't really sort of a metric that you're really, that's really crucial, I guess, in multifamily. I mean, obviously it's important, but it's not something that you're looking at. And I don't know. It's not the most important metric, I would say, that you're looking at multifamily. But storage, you're looking a lot more at square footage. But you're also looking at the micro market probably even more, because you have to look at where your micro market is. So your 3 mile and your 5 mile radius is super important to find out what your competition level is like, because in storage, the major threat that you have is competition. Is that it's easy to build, it's easy to convert, it's cheaper to convert and build. So you can have a lot of competition in your area, and that could drive down your prices a lot. So that's the major threat. Whereas, there's such an undersupply of housing that it's not a major threat. If somebody comes and builds an A-class property next to you, it's not really, you're probably like kind of happy. You're kind of like, oh, they chose a good place and they're going to drive up the rents, and my rents are going to probably go up along with theirs, right? So it's a little different when you're looking at, evaluating the deals. But in plain underwriting, a lot of the underwriting is the same. There's just some things that, like storage, I guess when you compare storage to multifamily, you're looking at probably in a 50% expense ratio, just kind of a rule of thumb. It's like 50% of your expenses are probably going towards, 50% of your income is going towards expenses. In storage, it's less. It's like 40%. It's kind of the rule of thumb that you can use, just kind of a back of a napkin type of rule of thumb. And that's because there's less like the turnover costs are significantly less. There's not as much utility costs. So utilities, you're not paying for water and people flushing toilets and things like that. You don't really have those costs, and even your electrical costs are significantly lower than most multifamily. So your costs are lower, and so those are some of the things that you got to think about when you're doing your underwriting.
I'm guessing cost is lower, but so is your income. That's why it's still 40%, not 20%. Right? And comparing to an apartment, we got payroll, multiple people, 5, 6 people on payroll, right? You have, taxes, insurance. Okay, you can say those are washed, but like all the other miscellaneous things. But I guess the thing I realize is your income is also lower, right? You're making, more per square foot of an apartment than storage, right? So I guess that's why.
It's hard to say, really. That's kind of market driven, right? So it depends. Some markets you look at, they can be, in the, say, $1 to $1.20 per square foot, right? Which is pretty comparable to a lot of multifamily, right? And it's all over the place. So some are really low, like the one I bought that one in Baton Rouge that I closed is like, right now it's currently like 56 cents a square foot, right? The market's about 70 cents a square foot. So it's probably lower than a lot of other multifamily. But there's other places, like I just did a tour of a A-class facility here in Orange County, California, which is, A-class, expensive area, really nice property. And I asked them their dollar per square foot, and they said it's $3.75 per square foot, up to $4 per square foot in the summertime. And I was like, that's really high. I don't see any multifamily that we're buying anywhere near that number. So.
Well, that's because if it was any cheaper, people would have lived in self-storages in California. Expensive housing is, right? So yeah, I know that's what everyone is thinking. All right. Well, then you want to continue on. So, okay, you talked about how you got educated. You talked about the deal, kind of things you were looking at, kind of tied together, right? How did you finance it, which is a critical piece, right, of anything? And then the other piece of that too is what did you, in terms of the equity, right? Did you buy it yourself? Did you do something else, right? Kind of help people understand that. And maybe also, given that we're not real estate masters, right? Tie it back to real estate in terms of how each of those things compare, right? And to what people expect.
Yeah. So structure wise, I did structure this as a joint venture, and I plan to do joint ventures probably from now on, instead of syndications. And that's because just in terms of size of properties. So the size of the property was, it's $675,000 for the purchase price of this property, which is not that much, obviously, compared to many of the syndications that you're seeing, right? So the syndications can be $12 to $30 million, right? And so 675 is not a big purchase price. So I didn't need to syndicate it, right? It'd be an overkill to syndicate this. But also, I'm coming from the multifamily background, and nobody knew that I was necessarily going into storage at that time. And I didn't really want to bring in any investors. I just wanted to bring in maybe a couple of family and friends. And so I didn't want to get a big deal. I wanted to get something that was manageable. And even though its purchase price is pretty low, it's 20,000 square feet. It's 175 units. So it's not small. It's a decent sized property. It's just that the purchase price is pretty low. That all said, so JV'd it with a couple different partners. Plan is to continue to JV it. I do structure it a little bit like a syndication. It's a little sort of complicated to get into at this point, but it is modeled after syndication, but the actual structure is a JV. Okay. However, the big difference, I guess, with the JV and the syndication is that the JV is that everybody has to be active, right? Everybody is active. So everybody is getting all the communication. Everybody is understanding where we are with the process and has voting rights and things like that. And also everybody's also, what do you call it? Everybody's also liable too, right? So you're not a passive investor where you're not held liable. You are potentially liable in this property as a joint venture. The second part of what you asked about the lending side. So the lending I found in multifamily to be much more straightforward than storage. Self-storage, the lending seems to be all over the place, especially because when you're dealing with loan amounts that are under $1 million, you're talking about bank loans, and bank loans can be all over the place, right? This bank doesn't have to, may hate storage. We found one that, a couple of them that were like, they just told us, you know, you need to have such, I don't know, they just basically didn't like storage at all. You know, their terms that they had, they didn't like storage at all. There's other ones that really like storage. There's other ones that specialize in storage, and your loan terms can be all over the place. Plus you can add SBA lending so that you can get government lending as well as, so that adds another wrinkle to it. But there is no Fannie Mae, Freddie Mac. That's only residential. So there is CMBS, and there is life insurance when you get over that $1 million mark. So that could be similar to, say, Fannie Mae, Freddie Mac in multifamily, but there is, the lending is definitely, I would say, a little more wild, wild west, a little more not so uniform than multifamily.
And recourse, right?
Yeah, a lot of them you're gonna have recourse, right? So, you know, under $1 million, certainly recourse. SBA lending, even though it can be over $1 million, and it could be over $1 million, it could be significantly over $1 million, but it still will be recourse as well.
Right? So you want to talk about what you end up doing ultimately?
Yeah, sure. So actually, our plan was, SBA basically said no to us, and in a weird way, because they said we're, you know, I brought in what I thought was a strong team, and a really strong team in terms of liquidity, net worth, and you know, these type of things, experience. So I brought together a strong team, and the SBA said, you guys are overqualified and you won't qualify for our lending. And I was like, what? Okay. So we just, all of a sudden, I never heard of that idea that you guys you're overqualified, basically, is what they said. So they wouldn't lend to us. So then I had to go through either a bank loan or go through like a bridge loan. And then I decided that really the bank lending, the terms that we were getting weren't the best. I didn't really think that they were the best, and I didn't really want to get into it. So I sourced out one of my private lenders and basically asked them, hey, and told them I can pay this much to a hard money lender or the bank loan. It's going to be about the same what I would pay you at this percentage. If you would like to, I could just put you in and just have you be the private lender on this. And they said yes. So basically I have a private lender who funded the debt on the side, you know, funded the debt, joint ventures on the equity side. And so right now it's basically like a bridge loan with a private lender, right? And then so the plan is to loans we can for 2 more, so we're refinance that out and return that capital to our private lender.
Got it. And maybe last but not least, what were the interest rates that you were kind of seeing?
I was seeing about 5%. So now again, these are banks, right? So 5% amortized from anywhere from 15 to 20 years. So 5 to 5.25%. 5-year terms. Some were willing to entertain a little bit longer, maybe like a 7-year term. And so that's why I thought these terms aren't really that great, right? And these are bank loans,
right?
So
which
these are bank ones.
Yeah, and for those that are kind of newer, right?
And recourse,
where you're getting 30-year amortizations, you're getting, 5 to 10 years, right now 3.25% interest rate. Mm-hmm. So yeah, definitely nowhere near as nice. Yep. Awesome. Well, perfect.
Hey, Powell, I got a question for you. For you. If you had to go back and redo your very first storage facility, You had to redo the entire, everything about it, loan, finding the deal, everything. What would you do differently?
Let's see. You know, truthfully, the only big obstacle that we had really was the lending side, just understanding it and learning the lending side. I thought that coming from a multifamily background and having, you know, been on a general partner on 5 different syndications, that would have lent a lot more weight to a lot of the lenders, but it really didn't lend that much weight to them. We also were picking up a property that was of heavy value add, right? 65% economic occupancy, right? So only 70% physical occupancy, right? And we're planning to bring it up to 85, 90%. But they basically said to us, well, maybe you've done something like that in multifamily, but truthfully, you haven't done it in storage. And we don't really feel like you've proven that you can do that in storage. And I was like, okay. So the lending side was really the major obstacle. Everything else fell through like pretty quickly. You know, the putting together the equity. I only asked 7 people, all friends and family, like close friends and family. I only asked 7 of them. 6 of them said yes, and they told me within 24 hours, yes, I'm in. And I was like, I've already raised it. I raised it in 1 day. And it obviously wasn't that much to raise, but I didn't have to worry about the raise. The raise was easy to do. You know, it's really the lending side that really kind of kept everything like as a question mark. So I guess I would just say that like you'd have to do a lot more research, specifically looking at storage lenders, not thinking multifamily lenders are going to help you out in the storage side, and not, you know, so I would just look specifically at lower storage lenders.
Interesting.
Awesome. Thank you, Powell. So
Okay.
I guess, you know, I was dwelling a lot on storage because I know that's unique. So I kind of figured people want to hear that. But you know, if anyone has any questions, go ahead and leave them at the very end. So we'll go for about another 25 minutes. We'll kind of all go, and then Ed and Garrison. And at the end, we'll do kind of open Q&A, right? Where we'll spend about 10, 15 minutes asking the kind of rapid fire questions. And then we'll transition on to our breakout sessions. That said, Garrison, you want to go next?
Yeah, absolutely. So the deal that my team has under contract right now, it's a little bit smaller than what I would like. We have a 20 unit under contract in the suburbs of Atlanta. I started focusing in on Atlanta kind of when COVID started back in March, April. I flew into that city quite a bit, and I know Feras knows that city pretty well. Feras owns a lot of stuff in that city. I own nothing in that city as of right this minute. But we ended up getting a 20 unit under contract. When COVID started, I kind of switched gears. I get to speak at some of the biggest real estate conferences around the country, some of the biggest multifamily conferences. And oftentimes I talk about going direct to seller, how to form those relationships, how to do creative marketing and advertising to get directly to that seller in order to find some killer deals, because I lost my shirt in 2007, 2008. I am the pickiest person there is when it comes to finding a deal and closing on a deal. I've been there, I've done it, I've closed on properties. I don't need to say that I closed on something. It's either a grand slam or I don't want in. So when COVID started, I thought there was going to be tons of opportunity. I thought the market was going to crash. I thought the world was going to come to an end. I thought I was going to be buying properties for 10 cents on the dollar. So I started going to Atlanta every weekend. I started building all these relationships and putting a team around me to build the relationships with the brokers. 8 months later, couldn't find anything where the numbers were, at least nothing where we wanted to close on. So we ended up going back to the basics. We went direct to seller, found a killer deal on a 20 unit. The numbers and the cash flow are stronger than any 100 unit that we looked at. I couldn't be happier about this property, other than the fact it's a 20, not 100. But with that being said, I just now need to create scalability or create an economy of scale per se in that local market. And I've done this before. I've done that in Baltimore. Nobody moves to Baltimore and says, I want to move to Baltimore. I want to buy real estate, or I want to buy real estate. Let's move to Baltimore. Nobody says that. But I was able to create an awesome portfolio here in Baltimore by creating a strategy where I'll buy one property and then I'll start buying everything in the vicinity in order to create that large multifamily scale. So a little bit ago, I introduced my business partner, Brent. That dude is an absolute brainiac, not only in digital marketing, but broker outreach. And that's his job on our team, is that dude knows every broker in Atlanta. So we're working on trying to create that scale right now, but that's what we're working on at the moment.
All right. And so ultimately, what's your plan with it, right? In terms of the team, are you going to do JV like Powell? Are you going to try to syndicate it or take it down yourself?
Yeah, it's a smaller property. We originally had it under contract for right around 1.3, 1.4 million. We then went back and retraded, something I totally suggest not to do, but we did it because we found some structural issues that were not disclosed to us. So we ended up retrading it for about 200 grand less, 250 grand less. We are right now getting ready to do a small syndication just because I want my team to go through the motions of doing a syndication, because the next deal will be a lot larger and we have a couple other bigger things in the pipeline. So we're going to go ahead and do a syndication, small syndication. We're in the process of raising a couple hundred grand, not that much, maybe 600-700 grand. Plus we got a little bit of seller financing on the deal whenever we renegotiated or retraded it due to the structural issues.
Got it. Cool. And then last but not least, what are you doing on the management side, right? 20 units is kind of the space between, do you use third party? Do you self? And do you have boots on the ground there? Or, what's y'all's plan on that?
We have boots on the ground there. I have two business partners that live within 10 minutes of the property per se, but we're going to hire a third party manager only because that third party management company has a lot of inventory in their database, a lot of sellers who will be itching to sell in the next few months. And I'm trying to build that bond, build that relationship, because that property manager does not want to lose those properties out of their inventory when the owners decide to sell. And I think that I will be the front runner to buy some of that inventory off of them. So that was kind of our game plan with the property and the project in general.
Hey, Garrison, I wanted to ask, so, when COVID happened, you decided to go for Atlanta. So why pick Atlanta of any of the markets that I'm sure you could have picked along the Eastern Seaboard or in the South? Yeah. So why Atlanta?
I like Georgia. I like Florida. It's a 2-hour flight. It's an hour and a half flight for me. Super close, super convenient. I have friends there. I have place to stay when I'm there. It just made sense. Mm-hmm. And I thought there was a lot of growth and a lot of opportunity in the city in general. So it was a place that I wanted to go and hang out. Whenever I tell people to pick a market, like all the people in our mastermind, whenever they ask me, hey, I live in California, I need to pick a market. I live in New York, New Jersey, wherever, I need to pick a market. Where should I buy? Number one, where do you want to hang out? Atlanta's a cool place to hang out. Where do you have boots on the ground? I have a couple of friends. I have a couple of business partners in Atlanta. It just made sense. So that was really the big reason behind it.
No, Atlanta's a good market. I mean, I like to tell people, the investor, not just because it's a growing market, population growth, all that other thing, but you used to be able to find deals at attractive price points that make sense, right? And we're going to get priced out of Atlanta just because you have a lot of people coming kind of in from Boston, in from New York, who are used to doing these extensive rehab, $5,000 to $10,000 a unit like we do. They're doing $30,000, $40,000 a unit. And so, I feel like it's going to get hard to continue to buy in Atlanta. We'll another one of our deals there just because, again, there's just so much demand. But yeah, it's a good market.
And that was another one of our reasons for entering is, like right now on this property right here, we're spending about 22, 23 grand per unit on renovation. I've fixed and flipped probably 400 to 600 houses throughout the last 20 years. I've done complete renovations, 30 to 40 grand per unit in everything I have in Baltimore for the most part. That's how I created my value add over the last 3 or 4 years. And we're going to do the same thing, double down in Atlanta. A lot of people are scared of that amount of work. For me, it's just another day of work.
So how about the lending side though? You mentioned that you're kind of at about 1.3 or 1.1 million or somewhere around there. What are you guys thinking about lending?
I was hoping Anton was going to be able to do the deal for us, get some big loan, but I'm just a little bit short on that. So we're probably going, I'm not the guy that handles that part of it, but we're going with a small local regional type of lender.
Mm-hmm. Got it. For those that don't know, I'm guessing you're saying, Garrison, it's because for Freddie small balance, right? Or Fannie small balance.
Yeah.
So which is usually you need a $1 million or above loan amount, right? And you said your purchase price is 1.3.
It was 1.3 before we retraded. Then it got down to about 1.1. plus 25% down. I'm only looking at a
Yeah.
$800,000 loan somewhere in a big deal.
Got it. Makes sense. Awesome.
Yeah. And then, so like, where are you guys in the process right now? Like what happened this week, or like, what are your due diligence, or where are you guys past that, or where are you at right now?
This week last week we set up our investor portal. We met with the SEC attorney. So we went through that. This week right here, we're talking to the lender, getting all of our loan docs in order, and just getting ready to close the deal, plain and simple. We did all the due diligence a couple weeks ago. Like, I think it was 3 days. Brent is probably muted. I think it was 3 days before Christmas. Brent, myself, and my business partners flew into Atlanta, did some due diligence, just hung out with each other on a guy's weekend kind of thing. So we'll probably get that thing closed in probably about another 4 to 5 weeks or so. But we're past the due diligence stage. Everything's good to go.
Okay. So you're done with due diligence. Now you're doing the financing part of it, working towards the close.
Yep, just getting all the money lined up and ready to go. And it's such a small property. Worst case scenario is we pay cash for it. We put all of our own cash into it, and then we raise the money on the back end.
Mm-hmm. Okay.
All righty.
So Feras, let's hear about your deal, my man.
Yeah, so I'll transition to mine. So again, so it's another multifamily asset. So, I've not, didn't pull Powell and try to do something different yet. So for us, similarly, right, COVID happened, and, we made a strategic decision to basically double down on operations, right? It was kind of an opener for just us in terms of, okay, who are the guys that are going to get through the next 6 months, right? This is back whenever, March, April, you kind of didn't know what held. And so, we spent really a couple months just really doubling down on our management company and really building that up, putting in more systems, more processes, more procedures, open that up to third party, right? Well, fast forward to the summertime, and, we start kind of looking for deals, right? And really there was not a lot of deals during the summer. And then August, September, October, just a ton hit the market, right? And, and we're looking at deals far and wide. On Atlanta, every deal in, Houston, every deal in San Antonio, and most deals in Austin, we look at very, very closely, right? We have a very kind of robust acquisition pipeline, and very close on. There was one point in time that I was nervous we were going to have 3 deals on a contract at the same time, right? And 3 huge deals, right? 3 200-unit deals, and fortunately, we got nothing, right? And I like to tell people the problem with this business is second place is no different than last place, right? You either win or you don't. And so, we didn't. Right. Well, come kind of November, there was a deal that, got mentioned to us. We didn't look at it very seriously initially. Right. Well, it kind of makes start digging in, and it's actually in our backyard here in Houston, right, which is where we're based. And, it's a smaller deal, 136 units, but it's in a part of Houston, lots going on, right? In terms of, basically for those that know Houston, there's one of the basically biggest highways in the country that just got built. So Houston, you have downtown, and then you have the first loop highway around it. You have the second loop, and you kind of have a third one. Well, this fourth one, right, is the new really big one that got built. It's basically going to be longer than the loop. To complete the loop is longer than going from Houston to San Antonio. That's just how big it is, right? It's huge. But anyways, this highway just got completed last year. So it's opened up a lot of access to this kind of corridor that is already a really good part of town that now just, development, an area we were familiar with. And ultimately it was an asset that was owned by the same seller for 27 years. Right. And so again, one of the biggest in the country, the ones that own it, and have had it for 27 years. So very clean asset, well-managed, fantastic location. So it was really attractive to us. And we saw there's just a lot of opportunity in terms of, getting in there, injecting cash, and ultimately letting the area kind of transition and improve. And so we started doing a strong deal in terms of cap rate. It's really hard to find good cap rates going in. It had that. It didn't have deferred maintenance. And we've done deals that are heavy value add. I mean, we've deals and we've done the nicer deals. And, you start to learn to know who you're buying from, right? And so again, we knew who we were buying from. That made it attractive. And so all the things that we were looking for, right? And so ultimately we got it under contract and completed the due diligence, looked good. And, from then, basically, right, we syndicate, raise the equity, and, now marching towards the finish line. And so it's kind of like what Powell said, right? In this deal, and still have another storage open up next door, right? Well, in this deal, right, that whole area has so much new development that's actually all good for it. And one thing we didn't realize from us is kind of the southern end of a very large master plan development that's been going on. And so, for us, new developments in the area, look, there's a lot of demand for housing in that area. People want to live there, jobs are there, et cetera. And so, got us excited. And one thing we found out actually a couple of days ago is door now is being cleared out as well. So, we're looking for these kind of indicators that really tell us, hey, what does the long-term outlook look like, right? We're not in it to buy a deal for a year, right? We're in there for the, 5 to 8 year play. And so that's maybe the high level and the low level of the deal. I mean, I'll pause there.
Yeah, cool. I was going to ask you, Feras, like, with a couple things, like it being in Houston and you being in Houston and a lot of your other properties being either Atlanta or San Antonio or other places, did anything change, or what changed in Houston that now you're able to pick up something, but maybe the last couple of years you weren't really looking at Houston?
No, that's a great question, right? So 3-4 years ago, whenever we made a conscious decision to go to Atlanta, right, we did it because, we could not find deals at the right price points, meaning we couldn't find yield, right? Meaning the price that we bought it at was not producing enough revenue or cash flow for. That's what took us to Atlanta. I'm starting to feel the opposite, right? So Atlanta's getting really expensive. Price points have gone up. I'm not able to find much yield. Well, in Houston, right, between really, it's the fear of people thinking Houston's a one-trick pony. Houston's very diverse, very different than it was in the 80s and 90s, right? And so you have activity in terms of buyers in Houston, but Houston's, massive job and population growth still, right? It's still one of the fastest growing cities in terms of population, besides being a diverse city. And so it's got a lot of the good things that we look for. And ultimately the price point started making sense in Houston, right? Where you don't have as much institutional, especially because COVID. So we're starting to look at a lot nicer deals, right? Like I mentioned, we were close on 200-300 unit deals that were much newer than what we typically look for. And so together, we're starting to look at more deals in Houston than we used to. And to be honest, now we're looking at deals in Houston more closely than we are deals in Atlanta, right? Atlanta, we might sell out most of our deals in Atlanta if we can, and where it makes sense, right? And then continue to grow in Texas. It's just ultimately, what's going on in each of those markets. And so that's why we look at multiple markets to begin with.
Okay. And when in terms of finding this deal, it sounded like Garrison went, at first was looking with brokers, but then decided to go kind of back to his roots of off-market type and going direct to seller. So how did you find this deal?
Yeah, so ultimately, in the bigger stuff, right, there's no such thing as a deal that doesn't go through brokers, right? One way or another. Because ultimately, as a seller, it'd be reckless for me to not use a broker to try to save a quick buck, right? To be honest, the brokers have a deep Rolodex, who's hot for a market, who's hot for a certain type of deal profile, et cetera, right? And so, if you're selling, absolutely go through a broker, especially a very active market, right? And so, the brokers still control that kingdom, that access, and so, be conscious of that, right? And really work with your brokers, build that rapport. And so for us, again, it's a deal that was through a broker, right? It was a deal that essentially was being marketed kind of off. It wasn't blasted. It was really on a short list. And, a situation where a broker came across the deal and, he knew we're in the market and knew it might be a fit. So.
Okay. All right, good. And then where are you at right now in your process? So, or like when is your plan? Do you already finish your due diligence? Are you already done with that part? So working on the lending side, or what?
Finished the due diligence. We finished the syndication. The equity's raised in the account. Now we're basically figuring out debt and closing. So that's kind of the two pieces really that are left.
Mm-hmm. And then how far out are you from closing?
TBD. February, right? And we'll see if it's, when it ends up being, right? So we're still kind of waiting on getting financials and some other stuff from the seller and just figuring out all those things. So
okay, good.
We're aiming for, we were aiming for mid of February. So we'll see kind of if we end up hitting that or slip a little bit.
Yeah. I think it's good for people to hear kind of where we're at. And when you're when you're in the middle of those deals, what you're doing, like how fast you need to do your due diligence, as well as work on your financing period throughout that whole time, and sort of what takes precedent in your timeline.
Absolutely. For people to realize too, it's timeline slip, right? There's a lot of things that can impact the timeline. I mean, there's a deal that one is wanting us to do some management for, and PSAs can go on for a month or two, right? I mean, you never know what happens. And so for anyone buying a deal, just be conscious that have a high level plan of what your timeline is, but just be flexible, right? Mm-hmm. And that's why sometimes you see those 1031 buyers that are really aggressive. They are time constrained, right? And so nothing can blow up their workflow, because that actually has some real implications.
Yep. I got a question, but kind of for both of you too, since it sounds like, I think our audience would like to hear this too, of like, it sounded like there's been some shift a little bit, at least in what you've acquired recently. Maybe it's due to COVID, or maybe it's due to the things that have happened this last year. But it sounds like, the size of the properties, or maybe the areas, the location. I guess maybe could you tie it into like what your strategy was to COVID for both of you, or like why you chose this, or what adjustments you felt like you might need to make?
Kind of a loaded question. Garrison, you want to answer, or you want me to answer?
Go for it.
I think COVID proved just how resilient multifamily is, right? People need to eat, people need to drink, people need to sleep. The government supports that. And so honestly, while yes, collections across multifamily has dropped a little bit, right? Delinquency has crept up. People, didn't necessarily go off a cliff like, hospitality or some of the other industries. And so there's been a lot of activity in multifamily. I mean, I wouldn't say the shift that we made was just really double down on operations, right? Put a lot more in place just to kind of be the leader in operation. And that's what the next 5 years is going to be in terms of who does well and who doesn't, right? Operating more tightly, where, maybe the past 5 years, people have just been able to ride the market, rights all ships. And so I think the next 5 years is going to be a little bit different in that sense. And so maybe that's my answer to that.
Okay. Garrison?
My biggest takeaway from COVID was I was all about student rentals prior to COVID. I absolutely hate student rentals today. Students are not back in class at the universities where I've been buying for the most part. I have a lot of vacancies. Now I'm kind of torn. Like I said, nobody moves to Baltimore and says, I want to buy real estate. Let's go to Baltimore. The demographics of the city are not super clean per se. So now my dilemma is I have all these vacancies, no students, no bodies in them. Do I go ahead and do I mix in these type of city individuals living next to students, and then the students get pissed off or the students get upset, then the students don't want to renew their leases, and I potentially shift the dynamics of the entire property, or I just hold off and wait out for COVID to kind of finish up and school to get back on track as normal? All of my properties are located in this small pocket between Johns Hopkins University, Towson University, Loyola, and Notre Dame. And if I had to do it all over again, I would not focus on any student rentals. And that's been my biggest shift since COVID started.
Okay, good. Well, I think you guys are both been really forthcoming with those answers. I mean, you don't get those answers from a lot of people, truthfully, on interviews. And I think it kind of shows in your recent track record and what you're doing right now, that a lot of times you're probably opening up to more opportunities, right? So COVID kind of said, hey, there's more opportunities. Maybe you, for the previous, didn't want to look at a smaller property, and now you're like, yeah, I'm willing to take a look at that. And if it's a good deal, I'd like to get it. Same with me in storage, right? It's like, prior to COVID, I like storage, but I wasn't going to buy any. I wasn't going to look at it that much. I'd spent 95% of the time on multifamily, so I didn't have enough time to really think about storage at all. So it just kind of opened up some potential opportunities, I think, for all three of us as in our progress.
Hey, Feras, other than Houston and Atlanta, what markets are you looking at? Anything else?
Yeah, so I mean, we like most of Texas, right? Even Dallas, we like Dallas, but Dallas way too active. Ones are getting really expensive, and so in terms of doubling down, we like North Carolina, we like Charlotte, Raleigh, Durham triangle, kind of that whole pocket. Right? South Carolina as well works, and we do like Georgia as a whole, and we do like Northern Florida. So those are, we are doubling down and just the brokers and kind of the follow-ups and really trying to build that rapport, right? I liked Orlando a lot pre-COVID. I still like Orlando, right? But you don't think that you're going to have an epidemic that's going to shut down Disney and shut down all the parks, right? Which then leads to layoffs. You kind of don't know, but yeah, I mean, we still ultimately those are still growing markets that we like. So
perfect, man.
Awesome. So then with that said, right on time, let's spend the next 10, 15 minutes. People have questions, go ahead and ask the questions, right? We'll basically, rapid fire those, kind of ask them. And, again, feel free to ask what you guys are interested in, right? This is obviously for you all. And then maybe last but not least, after that, we'll do breakout rooms, right? Where we'll basically into groups of 7 people. And that's where you get to network and get to know other people, right? This business is all about relationships. It's the people, I mean, heck, I met person through, these types of events, right? You don't know who you might meet. You go do deals together, you do events together, and you kind of grow together. And so that's a huge part of this. With that said, let's go ahead. I'm going to go ahead and just ask the questions. I think this one was for you, Powell, which is how much of a loan did you need of the total loan amount?
So we, our debt partner put down 60%, right? So if you're looking at hard money or any type of private equity or private lender or something like that, you're probably going to ask them to put in 60 to 65%, and then you'll raise the rest.
And if you are a private lender, that'll do 80%, 90%, come talk to me. All right, let's keep going. What was the CF for the price point you were looking for, Feras? What does CF mean?
Probably cash flow, I think. I don't know.
Oh, the cash flow. I mean, ultimately, we're looking for, we are cash on cash investors. We look for cash flow. We're looking for 8 to 11 cash on cash throughout the life of the deal. Next question for the 3 of you. What is your main focus for 2021 priority? Powell, you first.
Okay, so my priority, I guess, right now is picking up, is riding the momentum that I have in storage. So, like I said, I have just closed on this deal. The seller also wants to sell another deal, right? So I want to jump on that really quickly. We try to have good relationship with him so that we can potentially pick up his second deal. And then I'm almost under contract for what would be another one, a separate one, right? So we're just negotiating the PSA right now. So we're pretty close, and got a really good team in place, a really good team ready for it. I see a couple people on the team here, and just feeling really good about that. So I'm trying to ride the momentum that I have right now in storage. Although, just on a quick note, last year at this exact same time, January of 2020, I was really close to getting a multifamily deal under contract, and it ended up being that the seller, I was basically the only buyer. It was totally off market. I just happened to randomly run into this one. I can tell you that story later, but that seller decided they wanted to do the rehab. They said, well, we're not going to sell it. We'll do our own rehab, and we'll fix it, and we'll do all this stuff. But then obviously COVID happened, and they weren't in the position really to do a lot of that rehab. And then COVID happens, so they aren't feeling probably very good. So I just reached out to them actually about 2 weeks ago, and just haven't talked to them in about a year. And they just said, Powell, great time to contact us. We'd like to talk to you about, seeing what we could do about this property. So it turns out I might have a good deal on that way as well. So.
All right, Garrison, you want to answer the question as well?
My big goal for 2021 is to simplify my life and focus on cash flow. No shiny penny syndrome. Stay focused on the big picture, which is cash flow, cash flow, cash flow.
All right, good answer.
Well, you first.
And yeah, I mean, I'll answer too. For us, it's kind of, again, just doubling down on operations, really spend the next couple of everything as much as we can, and continue to buy, right? And so, we're expanding to more markets. We've rebuilt our acquisition pipeline. It's pretty, I like it. I'm pretty excited about it. And so starting to leverage that out and, find the next set of deals. All right, so let's keep going. What are the cap rates you are looking for in multifamily storage? Garrison. No, I'm kidding, pal.
You want me to go? Okay.
Yeah, no, I mean, yeah. Well, what are self-storage? I think
Sure.
what are self-storage cap rates? That's the question.
Okay, so I mean, truthfully, I mean, they could be just like multifamily, sort of all over the place. They're probably a little higher than multifamily is right now. It's probably not as hot of a market as multifamily is. But that said, in terms of what I'm looking for, all my deals are have a heavy value add to it. So if I was going to tell you that like this deal has 65% occupancy, right? The cap rate on it is going to be terrible, right? It's going to be, I don't know, 2 or 3 or something like that. It's going to be terrible at that particular where it's at right now. But that doesn't mean I'm not going to purchase this deal. It's 65% occupied, right? I feel like I could get it to 85% occupied, and this could be a great deal. I would say that truthfully, I don't really look at cap rates necessarily. Like, what am I buying for the cap rate? I'm looking at if I think this deal is a home run. And to me, a home run is something that I can comfortably project that I'm going to be able to refinance in 3 to 4 years and return my investors 100% of their capital, right? That's what I want. That's the kind of deals I want to do right now. And that's what I'm looking for. So.
Awesome. All right, next one. Garrison, maybe you can shift towards grad students because they will work while going to school like med students. So.
Definitely thought about it.
Let's see, next question is, what was your big takeaway from 2020?
Yeah, well, I'll go ahead and start that. Just, you know, for me, I mean, I'm just kind of beating a dead horse here. That is kind of a shift to storage for me. I mean, I just feel like for me, it fits me a little bit better. Operations, I think, are a little easier. I think that it's also team-wise. I'm also going to be doing joint ventures instead of syndications, at least at this point. So I only want to work with a small group of people, and those you know, those tend to be like my friends or a lot of people in here, people that I know in multifamily masters, people that I just want to work with. I don't necessarily want to work with you know, 70, 80 passive investors who I may or may not know and things like that. So that's for me.
My biggest takeaway from 2020, be opportunistic. There are opportunities everywhere. If you're looking for it, just take full advantage of everything that's presented to you. Keep an open mind.
All right, I guess for me, you know, it's just, you kind of don't know what you know, right? I guess I've expected things to happen and things, you know, do happen. And I guess maybe the takeaway is ultimately cash flow is king, right? That's maybe the biggest thing. It's, you know, seeing how quickly the bridge debt market dried up. That was kind of interesting, right? And just knowing, you know, hey, going in less times like these, right? Like we have a deal in Atlanta where we're 65% leverage. I mean, you know how hard it is to not pay the note on a deal like that? It's very hard, right? And so a reminder just how powerful kind of your structure can be, right? Using the right structure on a deal. So yeah. Let's keep going. Powell, how are you finding storage deals?
So mine are through brokers right now. They're all through brokers. Nothing direct yet.
Yep. All right. Next question. What is the best way you have found to be the most effective to find good deals? To that one. I mean, building true relationships, right? Don't make it just transactional with a broker, right? Build a real relationship. Get to know them, be friends with them, send them, you know, things like you do with any other friend, right? So I had a broker send me sausage the other day. So, you know, like this guy had hunted it, and he got it processed at some fancy place and sent it to me, right? And so I'm going to eat that this week and try it out. Build that relationship. Let's see, next question. What are your top 3 factors to consider for choosing a market? Answer that really quick. For me, job growth, population growth, and yield, right? Are the price points, you know, attractive? There are markets that have job growth and population, right? Seattle, if you want to think of it, there's no yield. The price points are too high. And so, you know, you kind of try to find the balance of those 3. And sorry, the next one, I guess, is that me. Feras, in focusing on operations, where did you find the most money left on the table? Good question. The bar in management is really low. And so the most money is just about kind of keeping track of all the right things and really doubling down on revenue boosting things and expense reducing things, right? And I know that's kind of a very, what's the word, kind of, but it's just really true, right? So simple example, I mean, these are things that with any property, operations is all obvious things. We all understand paying rent. We all expenses like utilities, right? And so things like, for example, overtime, managing how staff does overtime, right? Bit of an art to that. And, trimming down overtime whenever it's not needed is an easy way to save a lot of money, right? On some of these deals. So like how we, what is the start of the work week and at what point in time do we do kind of a pulse and see, are people about to hit overtime or not? And do we need to we don't need you to do work this Saturday, right? Things like that are, very easy ways once you know about it to actually go and improve kind of the process. All right, next question. What data sources are you using for rent growth projections? CoStar, Yardi? I've noticed a lot of volatility in projections.
You got that one, Feras, Garrison?
I mean, we use CoStar. It's kind of, but really ultimately all of these they're all projections right now. Any projection that's trying to model in COVID is not a very useful projection. That's my.
Garrison, you have any other ones that you use, or CoStar?
CoStar.
Okay.
All right, let's see. So we're already up on time, so we'll probably answer like 2 more, then we'll call it a day. Let's see. In California, pal, or are they strictly out of state?
Yeah, all of mine are out of state, so everything's outside of California.
And then, at least if you had to start over, how would you find your first 5 investors?
I'll tell you, my first 5 investors would probably be my friends and family. So that's just who it is. Like when I first started investing, the first people I was telling about, the first people I was excited to tell them like what I was doing and how this is going to be great and how they should get involved and how they should learn and all the things that I'm learning and how excited I was, it was my friends and family, right? And then pretty soon they were just asking me, okay, like, hey, you got something? And they were the first people that I asked in my storage unit. So I know it sometimes can be a little difficult thing if you have this sort of weird, if you have that type of relationship with your family, you might not discuss money or you might not want to borrow from each other and things like that. But with me and my family, it's been, we're all just very open with it. So.
Absolutely. Good. Awesome. Well, then I say we call it a wrap. Right on time, everybody.
Okay.
Thank you all very much.
I am about to end this Facebook Live. We are about to hop in networking breakout sessions. In the meantime, we are multifamilymasters.com. If you missed any portion of this recording and you want to watch it, check out our YouTube channel. Typically, we launch tonight's meeting tomorrow sometime during the afternoon. Get on YouTube, type in multifamilymasters.com. If you're not a member of our Facebook group, search for the Facebook group multifamilymasters.com, 6,000 to 7,000 members. If you're looking to learn, shared network, and grow in this space, we have a mastermind. Feel free to reach out to myself, Feras, Powell, or Bethany. We would love to have you involved. We want to hold you accountable because we want to partner with you. So in about 50 seconds or so, we're going to launch into breakout rooms, and then we're going to come back to one large room. Then I'm going to let this channel open all night long. As long as you guys want to network, take full advantage of it. Anything else you want to add, Powell or Feras?
So how long are we going to do the breakout session for?
We'll do the breakout rooms for probably 5 to 7 minutes, 8 minutes or so.
Okay.
And then we'll all hop back in here to the main room, and then I'll jump off of here. And if you guys want to network, grab each other's contact information. Someone just asked a question, what would you do to find your first 5 investors? Get every person's name, cell phone, email that you talk to in your breakout room. First and foremost, take action.
Okay, I would say that let's
go. I was going to say basically our just a reminder too, next month's MFM Live, we are having Brandon Hall, a CPA, talking to, so very relevant, very timely. I think everybody will love that. He does a good presentation.
Awesome. Thank you guys for showing up. We do this once a month. Tonight I saw we had about 80 people on this and another 100 to 200 people watching it live. Thank you so much.